a surprise in the fight against U.S. inflation. The Consumer Price Index, a broad measure of the cost of goods and services in the U.S., fell slightly in June from May, bringing the annual inflation rate to 3%. With that drop, the market is now expecting the Federal Reserve to start cutting interest rates soon. Okay, so for more insight into the U.S. economy and this latest inflation information, let's turn to Ted Rossman, Senior Industry Analyst at Bankrate.com and CreditCards.com. Welcome back to the program. Thanks for taking time to chat with us.
My pleasure. Thank you.
Let's talk about a lower inflation rate. It sounds good, but what does it look like for the average consumer? What are they saying? Is there a feeling, oh, what a relief that they're everyday purchases? Or clearly, this is the kind of thing that really weighs on the very big purchases?
There's a misconception among a lot of consumers that lower inflation means that we're rolling the clock back to 2019 kind of prices. Unfortunately, lower inflation just means prices are still growing. They're just growing more slowly. And that cumulative toll the past 2.5 years has been about 20%. People are still feeling very strained by inflation, and that's masking other strengths in the economy. The fact that the job market's been good, the fact that GDP growth and consumer spending have been strong. We are seeing inflation come down. Sentiment is still pretty low, though, and now we're starting to see some cracks emerge in the job market and the consumer spending story. So all of this adds up to a likely September rate cut from the Fed.
Okay, so what's driving all of this? I wouldn't really call it a lowering of prices, but at least perhaps corralling them just a little bit. And a lot of good news there. Although I did read one interesting story before I came out here that houses are selling less than what they're listing for. Great news for buyers. But if you're putting your home on the market right now, trying to buy another one with higher rates, not too good.
Mortgage rates have remained stubbornly high. The average for the 30-year fixed rate mortgage right now is about 7%. That does represent progress because last fall it briefly hit 8% for the first time in decades, but mortgage rates are still quite high relative to the recent past. The vast majority of current homeowners have a rate below 5%. So the housing market is still stuck, although we do see some progress ahead. It's going to be slow progress, though. We've been seeing wage growth outpacing inflation for about a year, so that's good news. We need to see more of that, though, and there's a lot of inequality in the economy. We see it with credit card debt, for example. Half of Americans pay their cards in full, and they don't have to worry about it.
Wow, yeah.
They get rewards and all these buyer protections. The other half, they're paying an average interest rate of about 21%. That's one example, but you could also talk about the divide between homeowners and renters. There's a huge difference there. Somebody who has a fixed rate and is building equity versus somebody who's facing sharply higher rents and having a hard time entering the housing market. 60% of Americans own stocks. They've enjoyed record highs. The other 40% haven't. So, a lot of this is feeding into existing inequalities.
Yeah, and Ted, credit card debt is just death. You did touch upon that. So when is the Fed going to lower interest rates? Perhaps right now it's not a question of if, but how quickly?
The best guess at this point is a 1/4 point cut in September and then probably another 1/4 point cut in December. That's going to get a lot of headlines and it represents progress, but it's not going to be overnight relief. I mean, it's not going to change the average credit card rate much at all.
Sure.
Because that tends to mirror what the Fed's doing. So if that average goes from 20.7 to 20.2 by year's end, that's still a really high rate. Now, we could see more progress on the mortgage front because those rates often move in advance of the Fed. So if there is this continued foreshadowing that it's not just the 2 1/4 point cuts this year, but maybe there's a full percentage point of cuts next year, I mean, that's when we start to talk about rates falling through the 5s, and that could open up some activity in the housing market. It's going to be slow going, though.
Yeah, and also a busy week for Fed Chief Powell, speaking twice on Capitol Hill. And even without this new consumer pricing information out there, he said that the rates remaining too high for too long could wreck the economy. So how do you figure that's going to add into all of this?
The Fed has this dual mandate from Congress, so they're focused on maximum employment and stable prices. And the past couple of years, everybody's been talking about prices and inflation. The onus is starting to shift a little bit, and The unemployment rate is still low by historical standards at 4.1%, but it has ticked up nearly a full percentage point. So it was really, really low. It's still pretty low, but the Fed's starting to talk about that part of the mandate a bit more. The difficulty here is what the Fed is doing has a lag. So rate cuts and rate increases, they take a while to filter through to the economy. So the real art here is to start to remove restriction and to do it at an appropriate pace. It feels like September is when they're going to start to remove that restriction. But we have to remember that the Fed pushed rates higher by 5.25 points. That's not going to be unwound overnight.
Good stuff. Okay, Ted. And also, who is going to be the next president weighs into this, but that's a discussion for another time. We appreciate your insight.
No problem. Thank you for having me.